I think he's trying to, paint a relatively benign picture here, and that's what we got. We got a push yesterday. Unfortunately, for stock investors like myself, we're hostage to central bank policy. It's been that way for most of the last decade. It's certainly that way now. You saw it play out yesterday. Markets did not get the rate cut or the talk of a rate cut coming down the road, and they had a fit, and they sold off on the day. So that's the story we have right now. I can argue for a rate cut. You look at an inverted yield curve, the 10-year almost demands a rate cut at this point, but he's hostage to the political environment. The president's calling for it.
Forget about that, David, forget about the data. I mean, you could make the argument for a rate cut simply because the president of the United States is literally pounding his fist on the table.
Look, every president
for a 1% cut.
Well, that's off the reservation, and even more off the reservation is going back to quantitative easing. I hope we don't do that. Even that's where I part company with Jay Powell. The fact that we're not rolling off the balance sheet, even at $3.5 trillion, when we're going to get that's 7 times where we were pre the financial crisis.
But the Powell zigging, it sounds like Trump zagging, because that was not a Fed chair yesterday that sounded like he was going to cut rates anytime soon.
No, it looks like we're pushing, and they don't plan to do anything at this point. And look, most of this rally is largely on the heels of a reversal in Federal Reserve policy. And no matter what kind of analysis you do, stocks do not live in a vacuum. The risk-free rate is a really important dynamic. I can't make an argument that stocks are cheap right now. If we get back to 3.2% where we were back in October, you're going to see a market sell-off, because that's when risk allocators, that's when asset allocators, insurance company, pension plans, they'll de-risk just like they did then. They'll see an opportunity in the bond market, and they'll go there to match.
Because why? They're just looking for a 3% gain and a 2.5%.
They didn't want to be in the stock market in the first place.
Yeah, but a 2.5% yield drives you into the stock market, because the dividend yield on the S&P 500 is about the same yield on the bonds, and you're not getting any upside necessarily.
That's why we are so totally dependent on interest rates. At 3.2%, where we were there, stocks have to go lower because multiples have to go.
0.7%. If we got a 0.7% change,
it's a massive difference for an insurance company to match assets and liabilities.
It's 0.7%.
I don't care. It's a massive difference. You saw that money shift. Money poured out of equities once we got above 3.2. It will happen again, because A-rated paper for an insurance company is pretty attractive.
So we always tell our equity investor audience, you got to watch bond yields. And they say, well, why? Bonds are boring, and I don't like to buy bonds, and whatever.
It's important.
But the reason they watch it is because if we hit that 3.2 number,
I don't know if it's 3.2.
Whatever it is. I'm not going to hold you to that exact number. You know what I mean?
Something north of that, money has to come out of stocks. Multiples have to go lower. But we're not there. So right now, stocks are trending on.
So flip your logic. If we continue to go lower in yields, do we continue to go higher in stocks?
Likely. Yeah. Yeah.
There's a story on
risk-on environment.
There's a story on CNBC.com, I think it posted last night, where basically Wall Street banks are advising clients that we could get a rip up higher in the equity markets.
That's pretty frightening.
Larry Fink of BlackRock on CNBC the other day saying we could get a melt up.
That's pretty frightening, because everybody's scaling into the market. Everybody came in pretty asset light. Now everybody's in. Everybody's fully invested. Gets pretty complacent. That actually concerns me.
Okay, what's the risk? That they're hanging on as long as the market hangs on?
Usually by the time everybody gets in, I can't tell you there's a black swan out there. If it's living out there, it's probably something we haven't seen yet. But it's always concerning when everybody is bullish.
Well, we have Iran. Market doesn't seem to care about that. We've got a trade deal that's not done yet. I got Venezuela, which we'll get to in just a second, in complete disaster.
Tell me what victory is going to look like in that trade deal, and then I'll be more confident. I don't think we're going to get all the things that we wanted.
Fair enough, but isn't a deal itself a form of victory?
It is better than nothing, yes. And wherever we go, it's going to be better than where we were.
So where do you think stocks go from here?
If interest rates stay benign, then stocks are still the better asset class.